In the early morning hours of late 2025, the global financial nerve center experienced a catastrophic digital blackout that left traders from Tokyo to New York in a state of absolute paralysis. At exactly 22:40 GMT, the CME Group, the world's largest derivatives exchange which processes over $1 trillion in notional value every single day, saw its reporting systems go dark. For more than 11 hours, the plumbing of the global economy, spanning foreign exchange, gold, West Texas Intermediate Crude, and S&P 500 futures, was effectively decapitated. This wasn't just a minor technical glitch or a routine maintenance error. It was a systemic failure that halted the very heartbeat of price discovery for the entire planet. When the reporting goes dark at an entity like the CME, the world loses its ability to value debt, hedge against inflation, or even price the fuel that powers global shipping. By the time the markets were forced into a halt, billions of dollars in liquidity had evaporated into a digital void, leaving institutional investors and retail traders alike staring at frozen screens. The scale of the disruption was unprecedented in the modern era of high-frequency trading, where milliseconds often dictate the difference between a fortune made and a legacy lost. As the pre-open windows approached, the silence from Chicago was deafening, signaling that something far more complex than a simple software bug was at play. In an age where financial warfare is conducted via fiber optic cables, a total blackout of this magnitude suggests a vulnerability in our critical infrastructure that most are not prepared to handle. Welcome to Finance Unfold, where we peel back the layers of the world's most complex financial events to reveal the truth behind the tickers. To stay informed on the systemic risks that could wipe out your portfolio in a single trading session, please hit the subscribe button and turn on all notifications. We are building a global community of sophisticated investors, so please drop a comment below and let us know which country you're watching from today. To understand the gravity of a CME reporting blackout, one must first appreciate the staggering volume that flows through their Globex electronic platform. On a typical day, the exchange handles upwards of 25 million contracts, representing everything from the interest rates on your mortgage to the price of the bread on your table. When the data feeds stop updating, the invisible hand of the market is effectively tied behind its back. The official explanation provided in the wake of the late 2025 event pointed toward a catastrophic cooling failure at a major data center facility operated by CyrusOne. While a cooling issue sounds like a localized physical problem, in the world of server architecture, it is the equivalent of a total organ failure for the machines that run the global economy. Without proper thermal management, the high-density servers that process millions of trades per second are forced into an emergency shutdown to prevent melting their own circuits. However, the cooling failure narrative has been met with significant skepticism by cybersecurity experts and veteran floor traders who remember the ion markets hack of 2023. In that instance, a ransomware attack on a third-party software provider crippled the reporting capabilities of dozens of banks, causing the Commodity Futures Trading Commission to delay its crucial Commitments of Traders reports for weeks. The similarities between that targeted strike and the 2025 blackout are too sharp to ignore. A reporting darkness is often the first sign of a sophisticated cyber intrusion designed to mask larger movements in the market. By taking the reporting systems offline, an attacker can prevent participants from seeing real-time position changes, allowing for massive unobserved liquidations or accumulations. In the dark, the tape doesn't just slow down, it ceases to exist, making it impossible to audit what is actually happening within the exchange's matching engine. The financial impact of an 11-hour outage at the CME is measured in the hundreds of millions of dollars in lost fees alone, but the secondary effects are in the billions. Market makers who provide the liquidity that allows you to buy and sell instantly are forced to widen their spreads or pull their quotes entirely when they cannot see the underlying data. This creates a liquidity mirage, where prices appear stable on the screen, but any attempt to execute a trade results in massive slippage. In the 2025 incident, the EBS foreign exchange platform, which serves as the primary venue for trading the euro-dollar and dollar-yen pairs, was among the hardest hit. These are the most liquid instruments in the world, yet they were reduced to a standstill. When the benchmark price for the US dollar is no longer being broadcast, every other asset class, from emerging market debt to corporate bonds, falls into a valuation trap. The timing of such events is rarely accidental, as they often occur during periods of extreme geopolitical tension or high market volatility. In 2025, the outage coincided with a major breakout in precious metals, with silver futures testing all-time highs just as the screens went black. To the cynical observer, a technical failure at the exact moment a major resistance level is being breached looks less like a coincidence and more like a circuit breaker designed to protect concentrated short positions. Regulators like the SEC and the CFTC are mandated to provide ongoing surveillance, but their hands are tied when the data streams they monitor are severed at the source. The black eye for the CME, as described by top equity strategists, isn't just about the downtime. It's about the erosion of trust in the market's plumbing. If the world's largest exchange can go dark for half a day, the concept of a 24-hour market is exposed as a fragile illusion. We must also consider the role of API-related outages, which surged by over 60% in early 2025. Modern trading is no longer about humans shouting on a floor. It is an ecosystem of interconnected application programming interfaces. When a central node like the CME fails, it triggers a cascading failure across Robinhood, Charles Schwab, and Fidelity, as their internal systems struggle to reconcile trades that the exchange has not yet confirmed. During the 2025 blackout, retail investors reported missing thousands of trade opportunities as their limit orders were stuck in a state of purgatory. Because the exchange was halted, but the underlying economic news continued to flow, many traders found themselves trapped in positions that were moving against them in the gray market, while they were powerless to hit the sell button. This is the ultimate nightmare for any leveraged participant. The data center in question, located in the Chicago area, is part of a global network of over 55 facilities. The fact that a localized cooling issue could bring down a global exchange highlights a terrifying lack of redundancy. In theory, a disaster recovery site should have taken over within minutes. In practice, the transition failed, leaving the market in what is known as a split-brain state, where data consistency cannot be guaranteed. Cybersecurity forecasts for 2026 suggest that these infrastructure strikes will only become more frequent as nation-state actors move away from simple data theft toward active market disruption. The goal of a modern hack isn't necessarily to steal money, but to cause systemic friction that degrades the dominance of Western financial institutions. A dark exchange is a powerful weapon in a geopolitical standoff. While the CME stock price often remains flat during these events, the long-term cost is found in the confidence discount. When institutional funds begin to move their volume to alternative venues or dark pools because they fear a repeat of the blackout, the primary exchange loses its monopoly on price discovery. This fragmentation makes the entire financial system more brittle and prone to flash crashes when the lights finally come back on. As we look toward the opening bell after a period of reporting darkness, the pent-up volatility is palpable. Orders that have been building up behind the dam are released all at once, leading to massive price gaps and extreme stop-loss hunting. If you aren't prepared for the opening gap, the reporting blackout will have already claimed your capital before you even realize the systems are back online. The CME's data investigations team is tasked with ensuring the accuracy of trade data, but their work is retrospective. They can tell you what happened yesterday, but they cannot help you when the system is failing in real time. This leaves the individual investor in a position of extreme vulnerability, reliant on a system that has proven it can and will go dark without warning. In the sections that follow, we will examine the specific mechanics of the shadow hack and how a reporting failure is often used to liquidate specific classes of investors. We will look at the forensic data that suggests the cooling failure was merely a cover for a deeper breach and what you need to do to protect your assets before the next time the CME reporting goes dark. To the casual observer, the idea that a broken air conditioner could paralyze a $100 trillion financial ecosystem sounds like a script from a low-budget disaster movie. Yet, the official postmortem of the late 2025 CME blackout pointed exactly to that, a localized cooling system failure at the Cyrus 1 data center in Illinois. When the mercury rises in a server room, the heat-sensitive hardware that facilitates the matching of buy and sell orders is forced into an automated self-preservation mode. In a matter of minutes, the digital infrastructure that handles over 90% of the world's derivatives trading was essentially cooked from the inside out. The implications of this physical vulnerability are staggering when you consider the sheer density of modern finance. Every single tick of the S&P 500 futures and every fluctuations in the price of West Texas Intermediate crude are computed by high-performance clusters that generate immense thermal loads. When the cooling fails, the reporting doesn't just stutter, it goes pitch black. This creates a terrifying information vacuum where trillions of dollars in open interest are suddenly floating in a void without a reference price. Subscribe to Finance Unfold to stay ahead of the next systemic shock before the screens go dark again. During the 11-hour outage, the lack of data didn't just stop new trades, it effectively blindfolded the world's risk managers. In the foreign exchange markets, the EBS platform, a critical artery for the global banking system, ceased broadcasting its benchmark rates. This meant that a bank in London trying to hedge a multi-billion-dollar currency exposure had no way of knowing the true market price, leading to a spike in synthetic pricing, where brokers were essentially guessing values based on thin air. For the professional trader, flying blind is the ultimate operational hazard. When the reporting systems go dark, the bid-ask spreads, the difference between what a buyer will pay and a seller will accept, widen to astronomical levels. In the silver and gold markets, which were experiencing a bullish breakout at the time of the 2025 outage, prices began to behave erratically as liquidity evaporated. Without the CME's central reporting to anchor the price, silver saw sudden, inexplicable $1 drops that many suspect were triggered by shadow liquidations occurring while retail traders were locked out. The cooling failure narrative serves as a convenient physical excuse, but it masks a deeper crisis in market governance. CME Group is known to maintain multiple layers of redundancy, including secondary data centers and failover sites. The fact that an 11-hour outage occurred suggests that either the backup systems failed to activate, or more alarmingly, the data integrity of the primary site was so compromised that a switchover would have replicated the error across the entire network. This is often a hallmark of a sophisticated cyber intrusion masquerading as a hardware glitch. Consider the month-end factor that amplified the chaos in late 2025. The blackout occurred on the final trading day of the month, a period when trillions in options contracts were set to expire and institutional portfolios were undergoing rebalancing. By taking the reporting offline during this critical window, the exchange essentially trapped participants in expiring positions. If you were long on S&P 500 options that were about to expire in the money, the inability to close or roll that position could result in catastrophic financial losses, or forced physical delivery of assets you didn't have the capital to hold. While the CME maintained that its stock price was mostly flat during the event, the reputational damage was immeasurable. The derivatives market is built on the bedrock of certainty, the certainty that a price can be discovered and a trade can be cleared. When that certainty is replaced by a black box for nearly half a day, the last fortress of the financial system begins to look more like a house of cards. The incident underscored that we are not just reliant on software and algorithms, but on the physical sustainability of the centers that house them. The 2025 outage also had a profound cross-exchange impact that few retail investors realize. Markets as far away as Bursa Malaysia, which rely on the CME's technological backbone for their own palm oil futures, were forced to halt operations. This single point of failure architecture means that a mechanical problem in a Chicago suburb can cause a food price crisis in Southeast Asia. This level of centralization is a dream for malicious actors, and a nightmare for those advocating for a resilient, decentralized global economy. Forensic analysis of the trading data immediately following the resumption showed massive price gaps. In the oil markets, WTI crude was frozen at $59 per barrel during the blackout, only to gap significantly higher the moment the systems came back online. These gaps are where the big money is made and lost. Institutional players with direct fiber optic access often receive the first light of data, allowing them to front-run the retail orders that have been sitting in the queue for hours. The sheer volume of pent-up orders that hit the exchange at 7:30 a.m. CT when trading resumed was enough to cause secondary tremors in the system. When a dam of $600 billion in notional value breaks all at once, the result is extreme volatility and washouts of leveraged positions. Many traders found their stop losses triggered at the worst possible prices because the market skipped over their desired exit points in the opening frenzy. This is why a reporting blackout is often described as a wealth transfer event. Even the burgeoning cryptocurrency futures market, which CME has been aggressively expanding, was not spared. Bitcoin Friday futures, which had seen record-breaking volume just weeks prior, were frozen mid-session. This irony was not lost on the decentralized finance DeFi community, who pointed out that while regulated exchanges were going dark due to air conditioning issues, decentralized protocols continued to operate without a central point of failure. We must also look at the commits of traders, MixOT data, which the CFTC uses to monitor the positions of large speculators and bullion banks. Whenever an outage occurs, these reports are delayed, often by several weeks. This data fog allows large players to hide their tracks as they adjust their positions in the wake of the crash. If you're trying to track the smart money, a reporting blackout makes the trail go cold exactly when the information is most valuable. As the CME prepares to launch new products like 100-ounce silver futures in 2026, the question of infrastructure resilience is at the forefront of the regulatory debate. If the current systems cannot handle the thermal load of today's markets, how can they be trusted to handle the exponential growth of high-frequency AI-driven trading tomorrow? The CyrusOne incident may have been a warning shot, indicating that our digital economy has outgrown its physical container. In the dark hours of the blackout, some analysts noted erratic sell-offs in gold that occurred even while official reporting was halted. These phantom trades suggest that while the public-facing reporting systems were dark, certain high-tier participants may have still had a way to interact with the matching engine, or were trading in private dark pools with privileged information. This creates a two-tier system, the informed who can see in the dark, and the uninformed who are left to wait for the light. The phrase, "it was a hack," began as a whisper on social media but quickly gained traction among cyber intelligence firms who noted that the cooling failure conveniently targeted the specific servers responsible for trade reporting rather than trade execution. In a sophisticated strike, you don't shut down the whole factory, you just turn off the security cameras. By keeping the exchange running but dark, an attacker can manipulate the perceived price without being audited in real time. As we move into the final part of this investigation, we will look at the shadow recovery and the specific entities that profited most from the 11-hour silence. We will analyze the market gaps of 2026 and why the next reporting blackout could be the precursor to a permanent reset of the global financial ledger. The era of blind trust in centralized exchanges is over. The era of verification has begun. The shadow of the late 2025 blackout lingers over the financial markets like a persistent fog, raising a fundamental question that most institutional players are terrified to answer. Was the cooling failure a legitimate mechanical mishap or a brilliant piece of digital misdirection? As we transition into 2026, the forensic data suggests that the 11-hour silence was the ultimate stress test for a global economy that has become dangerously centralized. When the CME reporting goes dark, it creates a temporal blindness, where the past no longer predicts the future, and the present is hidden behind a wall of thermal alarms. This silence is where the most aggressive market participants thrive. During the 2025 outage, while retail traders were told to wait for a pre-open that kept being delayed, internal logs from major liquidity providers showed a different story. Dark pool activity, private exchanges, where institutions trade away from the public eye, didn't stop. It intensified. These shadow markets were trading CME-linked products using estimated values, essentially creating a private price discovery mechanism that the general public could not see or access. The result of this information asymmetry was a massive opening gap that punished anyone holding a leveraged position. When the Globex platform finally flickered back to life, the prices for S&P 500 futures and gold didn't pick up where they left off. They teleported to new levels, skipping over millions of dollars in stop-loss orders. For the average investor, this meant waking up to a portfolio that had been liquidated at the worst possible price, with no legal recourse against the exchange for its technical difficulties. To prevent yourself from becoming collateral damage in the next infrastructure collapse, you must understand the concept of operational redundancy. In 2026, relying on a single exchange or a single broker is no longer a viable strategy. It is a single point of failure. The banks that survived the 2025 blackout with their capital intact were those that had already diversified their execution venues, moving portions of their volume to the Shanghai Gold Exchange or the Intercontinental Exchange, ICE, to ensure they always had a live tape to trade against. The vulnerability of our data centers is not just a Chicago problem. It is a global crisis of scaling. As AI-driven trading accounts for an ever-increasing percentage of daily volume, the heat generated by these silicon-based investors is reaching the physical limits of current cooling technology. We are entering an era where the stability of your retirement fund is literally tied to the reliability of a chiller plant 50 miles west of Chicago. If the infrastructure cannot breathe, the market cannot trade. Cyber intelligence firms have noted that the 2025 incident occurred just as new AI governance protocols were being implemented at the CME. Some suggest that the cooling failure was actually an emergency shutdown triggered by a malicious AI agent attempting to poison the trade matching engine. By forcing a hardware shutdown, the exchange may have been trying to prevent a digital contagion that would have corrupted the global financial ledger beyond repair. The shadow recovery of early 2026 has seen a quiet but massive shift in how open interest is managed. We are seeing a migration to physical among the most sophisticated family offices, who saw the 2025 blackout as a clear signal that the digital representation of wealth is only as good as the electricity that powers it. When the reporting goes dark, the only thing that retains its value is what you can physically verify, a lesson that silver and gold stackers have been preaching for decades. As we look toward the next opening bell, the crazy event. The markets are bracing for isn't a crash, but a desynchronization. This is where the paper price on the CME and the physical price in the real world move in opposite directions, because the exchange's reporting is no longer trusted. We are already seeing the early signs of this in the basis trades, where the gap between futures and spot prices is stretching to levels unseen since the 2008 crisis. The CME's response to the 2025 disaster was to install additional redundancy. But true resilience cannot be bought with more chillers. It requires a fundamental rethink of market structure. If we continue to concentrate all global risk into a handful of data centers, we are effectively building a digital Titanic. The 11-hour blackout was the iceberg scraping the hull. The something crazy that happens next will be the realization that there aren't enough lifeboats for everyone. To protect yourself, You must treat every reporting outage as a hard reset. This means lowering your leverage, using physical settlement options where possible, and maintaining a cash reserve outside of the traditional banking system. The reporting darkness of 2025 proved that the system has a kill switch, and whether it is flipped by a hacker, a heat wave, or a deliberate institutional move, the result for the unprepared is always the same: total loss. We have journeyed through the mechanics of the digital blackout, the forensic skepticism of the cooling failure narrative, and the strategic shifts required to survive a dark market. The era of the always-on market is a myth. We live in a world of fragile connections and thermal limits. By staying informed and recognizing the shadow patterns that emerge during these outages, you can move from being a victim of the system to a master of its flaws. Thank you for trusting Finance Unfold with your financial education. If you are ready to take control of your future and navigate the complexities of this rigged game, please hit the subscribe button and join our community. We are dedicated to bringing you the professional, fact-based insights that the mainstream media is too afraid to broadcast. Your support allows us to continue this vital work. The opening bell is about to ring, and the screens are finally glowing again. But remember, just because you can see the price doesn't mean it's the truth. Stay vigilant, stay diversified, and always have a plan for when the lights go out. This is Finance Unfold, your guide through the digital fog. See you in the next deep dive.